What's going on, guys? In this video, I want to talk to you guys about some prop firm trading strategies that are going to help you pass some of these evaluations. They're also going to help you get payouts, right? Because ultimately, it's not about buying evaluation after evaluation after evaluation. It's about taking money from these prop firms. So the first thing that you kind of need to understand is how these prop firms work, right? How they make money. So you probably already have a clear understanding that the way that these prop firms make money is by challenge or evaluation fees from traders signing up. So for example, I'm funded with Top Step as well as Apex Trader funding. Now, the cost that it costs to sign up, it could be anywhere between $15 and $50 depending on the firm, depending on the account size, and they can range from $100, $150, so forth and so forth. Now, every time a trader signs up for one of these evaluations, there's a 90, 95, I would probably close to say, closer to a 98% fail rate, right? So what happens when a trader fails? You can either purchase a reset or you can purchase a new account, and that money continues to go back into the company. And when you do have profitable traders, the money that you're making from pulling out of the market is not necessarily money that you're pulling out of the market, but you're pulling money out of the prop firms from all of the other evaluations, signups, as well as reset fees. So now that that's established, what can you realistically do to kind of get a little bit of an edge on the prop firms? Because it's not just about how good of a trader you are, but it's how good of a risk manager are you once you get into the funded stage. Because a lot of times traders trade evaluations completely different than the way they trade funded accounts. And the ones who don't trade them different are the ones that continue to invest money and buy reset after reset after reset. With that being said, if it costs you, let's say $20 with Apex or $50 for a $50,000 account with Top Step, and let's say you put on a trade for 2 or 3% risk and you win 2, 3, 4 trades in a row, you get on a hot streak, the market's in a good market environment, you happen to catch a good trend day, you're able to kind of pass these evaluations relatively quickly. Now, the problem that tends to happen is when a trader does that, and they tend to pass extremely quickly, they take that same approach because they think about it like this: I just made $3,000, or I made $4,000 or $5,000 in a week, in 2 or 3 days. Now that I'm funded, I'm going to be able to do this each and every single week, and I'm going to take this one account from zero all the way to 10 grand or $15,000, and I'm going to be rich, right? And then you run into a bad trade and you get into drawdown and you didn't have proper size management and risk management in place, and you don't really understand how to control your emotions. Immediately what happens in the first week, about 80% of traders blow that funded account. And the additional tend to blow it within 14 days after getting funded. I know because I've personally been there. I've gone through funded accounts, I've been funded, I've lost accounts, I've gotten payouts, but there's a strategy to do it, right? The right strategy to do it is to understand proper risk management once you get into the funded stage. So however you choose to pass your evaluation, whether you want to slow grind it, meaning, make $100 here, $200 here, and take 30, 60, 90 days to pass, and then kind of continue on that same path once you're funded, is one way. The other way is to kind of risk 1 to 2% per trade and try to pass these things relatively quickly, because in the end, time is money. So once you get into the funded stage, you have to completely back down all the way on your position size, because a lot of these firms are only going to allow $1,000, $2,000, $3,000 worth of drawdown before you lose your account. So if you're taking trades at 1 to 2% risk per trade, you could essentially blow out that $2,000, $3,000, drawdown limit very fast. Like you can blow it out in a day if you're over trading. You can blow it out in a week if you go on a cold streak. So what you need to do is set up your risk management in a way that it's relative to the account size that you have. So for example, we'll use a $50,000 account. We'll say that we have $2,000 or $2,500 worth of drawdown. We need to be able to set up our risk parameters to a point where we can take 10 to 15 losing trades in a row. Not saying that it's going to happen, but at least give ourselves that kind of space and that kind of cushion to be able to lose 10 to 15 trades in a row before we potentially lose that trade. Now, the next thing that we need to implement is a daily drawdown limit, a daily max loss that we are setting for ourselves, not that the firms are putting into place for us. Because of course, you have a trailing drawdown on Apex. You've got that, intraday threshold $1,000 or $3,000 limit on Top Step, where if you lose that amount of money, they don't let you trade for that day and you can come back the next day. That's great. However, what tends to happen with that is a lot of traders will go into drawdown and they'll think about it like this. Well, I've got, $800 left before I get kicked off the platform. If I just take a couple more trades, I'll be able to make that money back. Wrong. When you do that, you're letting emotions trade and you're not trading the actual technicals, and then you tend to get blown out and lose that account. So what you need to do is, based on the limit, the drawdown limit that you have. Let's say, for example, it's $2,000 to $2,500. If you have that little bit of drawdown, you need to set some type of daily mental max pain loss, where if you do lose that amount, regardless if you get the most perfect setup, you have to walk away. So I would say personally anywhere between $150 and $250 on the day, and I would not trade mini contracts in the funded stage. I would only trade micros until you build up a cushion over that threshold. So each of these prop firms are going to have a threshold, whether it's $2,000, $2,500, $3,000. As soon as you get over that drawdown limit kind of just stays there. So let's say, for example, you make $10,000, you'll have like that $8,000 or $7,500 cushion where you can draw all the way down, giving yourself more risk before you actually get booted off of the platform. Until and only until you build that cushion up, and I would say at least 5,000 to 7,000, 10,000 would be even better. Until you build that cushion, you have to remain patient and you have to allow trade setups to come to you based on your strategy and not chase. So a lot of times traders will get into these funded accounts, and what they tend to do is they're so quick to pull the trigger because they want to get that first payout. They want to finally get that investment back. They want to finally get money for all the time that they've spent. And they just go on a barrage of trades that, some work, some don't. And in all honesty, your best traders out there are only winning at a 50 to 60% win rate. So if you really do the math in your head, if you're going to split hairs between losing and winning around 50 to 60% of the time, why would you want to over leverage yourself, put yourself in a bad situation where the market goes into a 2 or 3 day consolidation period where the ranges contract and the markets get a little bit more choppy? And instead of kind of sitting back and allowing the better setups to come to you, why would you overtrade and risk losing that account just in hopes of getting a potential payout, when you could just maybe wait another 2 or 3 or 4 or 5 days and then kind of get back on the saddle? That doesn't mean that you don't have to trade during those periods of times, but you can also size down, take profits a lot quicker, set a smaller stop loss in those particular situations, and actually stop trading. So it's not the fact that a trader doesn't really understand the technicals or understand a certain strategy or indicator. When it comes to losing accounts, what it really comes down to is emotions, and the emotions behind it and not being disciplined is what causes you to go on tilt. It causes you to revenge trade. It causes you to size and over leverage because you're reaching for this kind of expected outcome that you've had drawn up in your head for so long. And once you finally get there, you can almost taste it. And when you can almost taste it, it's just, you want to push a little bit harder because you've been practicing and you've been learning and you've been reading and you've been studying and you should be making money, right? That's the mindset that 90+% of traders have. When the correct mindset to have is, I don't need to pull money out of the market today. I don't necessarily need to have a green week this week. What am I doing? What's my P&L look like at the end of the month? What adjustments can I make at the end of the month so month 2 I can actually take a payout? And you'll be very, very surprised that when you do size down and you look at the markets in this kind of situation and you're okay with kind of compounding $100 day here, a $300 day there, how fast it actually adds up over a 30-day rolling span, right? So again, even if you make $100 average a day, that's $500 and $2,000, $500 a week and $2,000 a month. Now, if you want to make a little bit more money than that, all you realistically have to do is scale more accounts on top of that. So instead of having one account that's pulling out $2,000 out of the market, you have 5 that's now pulling out 10,000. You kind of get the drift. But a lot of times traders will try to take that $150,000 account and they'll look at it as a vehicle where they can try to make $10, $15, $20,000 out of this particular account, when that's not realistic, because not every trading day you're going to get those opportunities and those setups. You're not always going to get those trending days. And what tends to happen is traders will find themselves in a particular situation off the open in the first hour, first 2 hours of the market, where the market that has a lot of volatility and it's going up and it's going down, and you take a losing trade here and you take a little paper cut here and then you win a little bit back. But all you're essentially doing is death by 1,000 paper cuts. You need to actually sit back, put in some good risk management parameters. You need to have a solid trading plan. And what you need to actually focus on is being okay walking away on a red day, being okay not taking a trade because it doesn't align with your trading plan and your trading strategy. This, my friends, is the most hardest thing to do in this business. This is probably one of the easiest businesses where you can scale exponentially in as far as the amount of money that you make, but it's probably one of the hardest businesses to actually withdraw money on, because this is a performance-based business. The better of a performer that you are, the more money that you are going to attract. So again, this business is not about chasing the trades. It's not about chasing the dollars. It's about being an excellent performer, an excellent executor. So if you don't execute your trade plan to a T and you don't perform well under pressure, you don't perform well when it comes to managing risk, then money is going to pull away from you. But the thing is that a lot of traders want to chase this, they want to chase the trades, they want to chase the money, they want to work so hard, and money just runs away from you. So understand how this business actually works. The whole entire stock market is built on emotions. It's a wide open worldwide marketplace when it comes to futures. And again, the whole market is built on people's human emotions. Now, of course, there's algos, of course, there's quants, of course, there's other types of, trading bots that are out there that are executing trades, but they're all set up around levels that are designed to cause emotional pain. And when they're around these levels that are causing emotional pain, such as supply and demand, or moving averages, or gap ups or gap downs, all of these levels are designed to trigger some type of human emotional reaction. And when you understand where these kind of candlesticks move around this human reactions, you're going to tend to see that if you're oversized in a particular situation where there should be something happening in the price action, you're going to physically feel that, because that's what this marketplace is meant to do. However, if you were trading, let's say, for example, you're trading one micro contract that on the MNQ that moves $2 a tick, and you're suddenly down 10 points, right? And now you're down $20, you're not going to feel too much. But if you're trading 10 micro contracts and now you're down $200, you might feel a little bit of pain. Does that make sense? Sometimes, a lot of times, traders don't understand the actual average true range that the NQ or the YM, which is the Dow, or the ES can move, where they over leverage themselves because they are looking at their trading plan, they're looking at their trading setup, and they see the trade start to formulate on the screen. So they take that trade and they don't think that the trade's going to fail. And once the trade starts to go against them, boom, everything starts to go sideways, and all of the rules and all of the discipline that you thought you had goes out the window. This is what I've been working on a lot with my traders at Evolution Traders, is trying to get you to understand that the losses are going to come. But as long as our emotions are in check and we work on our discipline on a day in and day out basis, and we size ourselves properly so that we can withstand these losses and withstand the pullbacks and withstand the waves, that you can come out profitable on the other side. But it is going to take a little bit of time. You can't look at each and every single trade as a singular kind of mechanism. You have to look at this thing as a series, as a block, right? And the perfect number for that is 20 trades, right? You need to get through 20 trades. You need to see, how did you handle these trades emotionally? How did you handle your risk management during these times? How did the market kind of react during this week or few days or a couple weeks where you took these 20 trades? And then from there, you can start to make some fine-tune adjustments. But if your risk management is not in place to where you can't even take 20 trades, how are you ever going to truly analyze and assess what you need to do right or what you need to do wrong? What you can continue doing that is correct, and what you need to fix that is a mistake. If you guys want to join and trade with me each and every single day live, make sure you guys join Evolution Traders down at the link down below. I'm accepting a couple more traders before the end of the year, before we go into 2024. We've got live trading in there. We've got live webinars. We've got strategy lessons in there. We've got daily watch lists. We've got daily technicals and an online community where you can jump on the headset, your AirPods or whatever, the phone. You can talk to us each and every single day live. Set up those one-on-one mentorships. I'll see all of you guys on the inside. To everyone else, make sure you like, comment, and subscribe, and I'll catch you guys all next time.